Leases are important financial arrangements that allow companies to obtain the use of assets without purchasing them outright. The program explains that leases are contractual agreements in which the lessor grants the lessee the right to use an asset for a specified period in exchange for periodic payments. Leasing is widely used for assets such as buildings, machinery, vehicles, and equipment because it provides operational flexibility and may reduce the need for large upfront capital expenditures. Lease accounting significantly affects financial statements, profitability measures, leverage ratios, and cash flow analysis. Analysts must therefore understand lease classification, recognition, and disclosure requirements because leasing decisions influence both financial performance and assessments of long-term solvency and operational efficiency. Under current accounting standards, most leases are recognized on the balance sheet by lessees. The lessee records a right-of-use asset representing the right to use the leased property and a lease liability representing future payment obligations. This approach improves transparency by reflecting lease commitments that previously may have remained off balance sheet under older accounting rules. Lease liabilities are measured as the present value of future lease payments, while right-of-use assets are initially measured based on the lease liability adjusted for initial direct costs or prepaid lease amounts. Analysts evaluate these balances carefully because lease capitalization increases reported assets and liabilities, affecting leverage measures, return ratios, and assessments of financial risk. Lease accounting affects the income statement through recognition of depreciation and interest expense. The right-of-use asset is depreciated over the lease term, while interest expense is recognized on the lease liability using an effective interest method. As a result, lease expense patterns may differ from straight-line rental payments. In earlier periods of a lease, total lease-related expense may be higher because interest costs are larger when the liability balance is greatest. Analysts must understand these effects because lease accounting influences operating profit, net income, and earnings trends. Companies with extensive lease obligations, such as airlines, retailers, and transportation firms, may report significantly different profitability and leverage measures after lease capitalization. The classification of lease-related cash flows also influences financial analysis. Lease principal repayments are generally classified as financing cash outflows, while interest payments may be classified differently under IFRS and US GAAP depending on accounting rules and company policy choices. Operating cash flow often appears stronger after lease capitalization because portions of lease payments previously treated as operating expenses are reclassified as financing activities. Analysts therefore adjust cash flow measures carefully when comparing companies with varying lease structures or accounting treatments. Understanding lease-related cash flow effects is important for evaluating liquidity, debt repayment capacity, and financial flexibility, especially for companies relying heavily on leased assets to support ongoing business operations. The program also emphasizes the importance of lease disclosures in evaluating financial risk and contractual obligations. Companies disclose lease terms, discount rates, maturity schedules, variable lease payments, renewal options, and future lease commitments. These disclosures help analysts assess the duration and magnitude of lease obligations and evaluate how leasing affects operational flexibility and solvency. Analysts frequently compare lease liabilities with traditional debt obligations because leases create fixed payment commitments similar to borrowing arrangements. Long-term lease obligations may significantly increase financial leverage and expose firms to liquidity pressure during economic downturns. Careful analysis of lease disclosures therefore improves understanding of a company's capital structure and long-term financial sustainability. Lease analysis is essential because leasing decisions influence profitability, leverage, cash flow patterns, and investment valuation. Some companies prefer leasing to preserve cash, avoid ownership risks, or gain tax advantages, while others use leasing to access assets without significant upfront financing. Analysts adjust financial statements to improve comparability between firms that lease assets and those that purchase them directly. A thorough understanding of lease accounting allows analysts to evaluate the economic substance of financing arrangements rather than focusing solely on legal ownership. By integrating lease analysis with broader assessments of profitability, solvency, and cash flow generation, analysts can better evaluate operational efficiency, financial risk, and the long-term sustainability of corporate business strategies.